If you live or work in one of the 41 states that have an income tax, you need to determine what state or states you need to file returns for and pay taxes to. For most people, this is pretty straightforward, but for some, it can be a bit challenging, particularly if you move from one state to another. I'm the Tax Geek, and here are part-year state tax returns, oversimplified. If you've lived in a state for the entire year and all your income was reported to that state, you file a full year resident state tax return and pay all of your state income tax to that state. But what if you move from one state to another? In this situation, you may have to file multiple state tax returns to make sure you pay the correct tax to the correct state. Most states that have income taxes have three types of returns: full year resident, part year resident, and non-resident. You file a part-year resident return if you lived in 2 or more states. First of all, what establishes residency in a particular state? It can be changing your permanent address to that state, obtaining a driver's license for that state, registering to vote in that state, renting an apartment or purchasing a home as a primary residence in the state, filing for a homestead exemption in that state, or establishing bank accounts in that state. Of course, this is not an exhaustive list. However, notice I didn't say having income reported to the state. That fact, in and of itself, usually does not establish residency. When you live in 2 or more states, for oversimplification's sake, let's make it 2, on different days of the year, you are part-year residents of those states and have to file one part-year resident tax return for each state, assuming each state has an income tax. Next, you have to determine when your residence actually changed. A general rule of thumb is the actual change of residence date occurs when you spend the first night in your new resident state. This is not necessarily the first night in your new home. For example, if you arrive in the state on August 15th, but don't move into your permanent home until September 21st, your residency starts on August 15th. Even if the moving process takes several days, you are still considered the resident of one state or another. You are never not the resident of any state. What about married couples? Sometimes one spouse will move and for one reason or another, the other will stay behind and move at a later date. What happens varies by state. Some states establish residency for the couple as a whole, and others allow different lengths of residency for each spouse. For states that don't allow couples to have different residency dates and the spouses move at different times, residency in the new state is usually determined by when the bulk of the family moves to the new state, or when any of the actions to establish residency I mentioned earlier occurs. Here's an example of how part-year residency works. Jan and Dean are residents of North Carolina on January 1st, 2025. They moved to Rhode Island in September of that year. They spent their first night in the state on September 20th, and right away they obtained driver's licenses and registered their automobiles in Rhode Island. Both Jan and Dean had W-2 income in North Carolina, $36,200 and $27,900 respectively. Only Jan had W-2 income reported to Rhode Island of $18,750. They also received $350 in bank interest from their North Carolina bank. They will file jointly, have no dependents, and will take the standard deduction in both states. North Carolina and Rhode Island represent 2 different approaches to handling part-year returns. For both North Carolina and Rhode Island, all income reported to that state is divided by the total income from all states, yielding a percentage, which is also called a ratio. North Carolina applies the ratio to the taxable income from all states, whereas Rhode Island applies the ratio to the tax on the income from all states. Let's see how this works by looking at their state tax returns. For North Carolina, we start with Schedule PN. First, it shows the dates of residency for both the taxpayer and the spouse, since North Carolina allows for different residency dates for spouses. Column A from Schedule PN shows the total income from all states, and Column B just shows income reported to North Carolina. Column B is divided by Column A, giving a ratio of 0.7740. Now we switch to the D400 tax return. It shows the income from all states and subtracts the standard deduction, resulting in a taxable income. The ratio from Schedule PN is then applied to the taxable income, and the result is multiplied by the state income tax rate, resulting in a North Carolina state tax liability of $1,898. For the Rhode Island return, we start with Schedule 3. The residency dates are shown here. Rhode Island does not allow for spouses to have different residency dates. Just as before, we separate the Rhode Island income from the income from all states, dividing the Rhode Island income by the total income to show a ratio of 0.2250. At this point, we switch to the RI 1040NR tax return. We take the total income from all states, subtract the state's standard deduction and personal exemptions, and apply the state's tax rate to the result. This figure is transferred to line 15 of Schedule 3. The ratio is applied to this figure, and the result is placed on the last line of Schedule 3 and shows up on the RI 1040NR as a Rhode Island state tax liability of $432. And again, keep in mind that every state with an income tax does things slightly differently. If you have questions, check out that state's income tax website or engage a qualified tax professional familiar with multiple state returns. Links to additional resources and information can be found in the video description. If you found this video informative, please give the video a like and subscribe for more content. Please share this video with anyone who might find it useful. Your questions, comments, and suggestions are always welcome. Thanks for watching, and stay tuned for more of Your Taxes Oversimplified.